Hey, John Stevenson here, the Guaranteed Retirement Guy, and I want to talk to you about how to calculate your income tax on your annuity payments. So taxes. Yes, taxes. Don't we love taxes? We paid taxes our whole life, and we're going to get income now for our retirement, and we're just going to keep on paying taxes, right? Uncle Sam loves getting his taxes, and we have to pay it one way or another. Unless, of course, you're in a Roth IRA, then all of your annuity payments will be, of course, tax-free. But we don't live in a perfect world, and a lot of us don't have a Roth IRA, and a lot of us don't want to convert because we don't want to pay all the taxes on it. And maybe your income is going to be a lot less in retirement than it is right now. And so in that case, usually it's not a good idea to convert, but that is a question for your tax professional, your accountant. And I'm just going to make that disclaimer now. I am not a tax professional or an accountant, but I am here to kind of give you a high-level view of tax planning for your annuity payments. Different types of annuities, obviously you're taxed differently depending. So if you're taking an immediate annuity, and let's say it's inside of an IRA, then everything that comes out of an IRA is, of course, taxed as ordinary income. And that is taxed forever, for the rest of your life. That's just how it goes with regular IRAs, 401ks, any tax-deferred account. Now, if it's not an immediate annuity, and let's say you roll some money into an IRA, and it's going to sit there and it's going to grow for 10 years before you take income, then of course you're not taxed because it's still inside of an IRA. It's still growing tax deferred. But at the end of the 10 years, you turn on that income, you're going to get taxed. Okay, that's just how it works. Now, a lot of people come to me with brokerage accounts or just money sitting in their bank account and it's already been taxed. And they're looking to purchase a guaranteed annuity, maybe immediate, or maybe something a year from now they're going to start taking income, or maybe they'll defer it for 10 years. It's the same case with non-qualified annuities as far as tax deferral. So any earnings, any growth is tax deferred, even if it's a non-qualified annuity, which is great. That's a great thing that annuities provide regardless of how you fund them. Now, of course, if you take that money out, as income, let's say you put in $500,000 and you turn on an income stream in 1 year, and let's say you're taking $35,000 out a year. Well, that's subject to the exclusion ratio, and of course, that basically determines how much of that is going to be taxed. And they look at your life expectancy. There's a few calculations. I actually created a video about that earlier that talks about exactly how to calculate that. But usually what happens is a portion of that, a smaller portion of that payment out of a non-qualified annuity is taxed. And it's taxed as ordinary income. But the larger portion of it is completely tax-free because it's considered a return of your already taxed principal. Now, of course, as years go by, you will get to a point where they will have paid you all of your principal out, plus all the earnings that you've been taxed on partially during that time. So you've been partially taxed for part of your payment. But then, of course, you've used up all of the principal, and it's an annuity contract, so they're going to continue to pay you guaranteed income for the rest of your life. That's a sweet deal when you're thinking about just not having to stress out about whether or not that income is going to be there. So basically what happens at that, let's say at the end of 20 years, you've taken out all of your principal, and of course, they've given you some earnings at the same time, which of course you've been taxed on that. And after that, they're going to continue making those payments. And so maybe it's $35,000 a year, and they continue to make those payments for, let's say, another 15 years. Well, at that point, they've already returned your principal, which means you're going to be taxed fully on that $35,000 every single year as ordinary income. So that's how that works. Now, here's what I would recommend. Talk to your accountant, talk to your tax professional. You know your situation. They know your situation. And you might have some money coming out of a Roth. You might have some money, obviously you got pension money, and that's taxed as income, and IRAs. Annuities, of course, provide you guarantees that you can't get anywhere else. And then we can sit down, and if you'd like to chat about your situation with me, you'll notice that there is a link below this video, and you can just book a call. It's that easy. And we'll go over your situation. We'll look at your income needs. We'll look at exactly how much income you need, and of course, how much you don't want if you are trying to limit your taxes. And so we can look at that together as well. There are annuities out there that you can convert to a Roth. So something to think about. You can always put the money into the annuity, let it grow tax deferred, and maybe during that time convert it to a Roth. You can do that. And then your income's still the same. It's still going to be a guaranteed income, but now it's tax free. So anyway, something to think about. We can talk about that on our call. But yeah, if you like this video, please subscribe, like it. And yeah, if you want to talk about your situation, then book a call on the link below. So anyways, I appreciate you watching the video, and we'll see you next time.